What's up YouTube, David here. Today I want to dive into dividend stocks. There's always people who want to start learning about passive income, and in my opinion, dividend stocks are a great place to start. Let's face it, who doesn't want to just buy a stock and then go scuba diving in the Maldives while it earns you an income? First, we will look at the pros and the cons, then we will talk about what to look for in a stock, and lastly, I'll show you 3 dividend stocks that I'm personally interested in. Oh yeah. If you don't have a brokerage, use my link to Webull in the description so that you can get 2 free stocks when you sign up and make a direct deposit of $5. Now we can roll the intro. Alright, so understanding dividend stocks can be a bit overwhelming, so I'm going to break this down step by step. Let's start with the pros and cons of dividend stocks. Pro number 1 is passive income. So the way this works is very simple. If you own the stock, you will receive a dividend at certain times, typically every quarter. Dividends are usually given out by larger companies that have decided to pay back a portion of their profit to their shareholders. It is entirely possible to build up a dividend portfolio that is so large you can live off the dividends themselves. But fair warning, it will take quite a bit of money to get to that point. The second pro builds off the first one, and this is what I mainly do with my dividend stocks right now. You can automatically reinvest the dividends that you are paid directly back into buying more of the stock. So in these accounts, not only are you compounding interest, you're now compounding the returns from the dividends as well. Think of it like this. If you have 2 stocks that always have the same return over a 1-year period, but one of them also pays a dividend that you automatically reinvest, you'll be making more gains off of the dividend producing stock. The last pro, which something people tend to not think about as often, is inflation rate. Dividend stocks do a great job at hedging against normal inflation levels, and you can see this historically since dividends have increased about 4% in the last 100 years versus inflation increasing about 3% in the same time. So dividend stocks are pretty sweet, huh? Well, let's look at some of the cons before you decide. Con number 1 is that pretty much all dividends are offered by large cap companies, and this is due to the fact that they're already established and aren't needing that dividend money like a small or a mid cap would to expand and grow. Since these larger, slow moving companies aren't exploding in growth, it means that their share price is probably less likely to have huge upswings, but that also means they probably won't have huge downswings either. So I guess this is more of a pro-con? Con-pro. Con number 2 is that the share price of a dividend-paying stock will usually drop a little after a dividend is paid out, so don't freak out if this happens. It's pretty common. And lastly, a company that pays dividends can choose to change how much they pay or if they will pay a dividend at all. Dividends are not a guarantee like pretty much anything in life. The only guarantee we do have is that if you hit the like button, good things are going to come your way, just like if you forwarded those weird chain emails like 10 years ago to all your friends. So what should you look for in a dividend-paying stock? To help you not pick sketchy ones, I recommend looking at the S&P 500 Dividend Aristocrats Index. All you have to do is Google Aristocrats Index, and you can find a Wikipedia page that has all 65 of them on there. All of the stocks in that index have increased their dividends for, at minimum, the past 25 straight years, and based on that history, you can feel safer investing with them and having confidence they will continue to produce a good dividend for you. That leads me directly into the first thing I look for in a dividend stock, their track record. This is why I like looking at the Aristocrats Index, since I can see dividend stocks with good track records, and from there I can look closer at individual ones I may be more interested in. I'm a strong proponent of work smarter, not harder, so using a list that is already compiled that is based on historical data that I can use to narrow down my choices is a no-brainer to me. The second thing I like to look at is the payout ratio of the company. This may sound complicated to some of you, but it's super simple. Basically, all you do is take the total dollar amount of dividends paid in a year and divide that by the net income and then multiply it by 100 to get the percentage. Don't worry though, this percentage is already calculated for you, and if you just Google the ticker you're looking for or the company that you're looking for with dividends somewhere in there, you'll be able to find all this information pretty easily. If you look at Clorox, which by the way has had 45 consecutive years of dividend growth, you will see that they have a 60% dividend payout ratio. Simply put, this means they are giving 60% of their net income for the year right back into their investors' pockets in the form of dividends. This may shed some light on why smaller companies or growing companies don't do this. A company that is trying to expand would greatly slow itself down, if not fail, if they didn't reinvest all their profits into the company with buying more buildings or doing more R&D for the future products. The third thing I look for in dividend stocks is their dividend yield. So what does a yield mean? Well, if you had $2,000 and put $1,000 of it into IBM, you would make 4.64% off that, which is $46.40. And if you put another $1,000 into Clorox, you would make 2.46%, which is only $24.60. And this is over the course of 1 year, by the way. Right about now, you're probably thinking, well, obviously, you should just pick companies with the highest ratio. Done. Well, in my experience, that won't always work out too well for you. Let me explain why. You also have to take into account how well does the company do with its share price growing over time. If a company has an 8% dividend, but their stock drops by 12% that year, you made -4%, which, if you didn't know, gives me slight chest pains just thinking about. I will say that sometimes that dividend can be nice if the whole market takes a dive. It can help lower your losses. So if you're only losing that 4% versus someone else investing in something without a dividend and that stock drops 12%, they're losing 12, you only lost 4, but let's not focus on losses because they're not fun, right? With all that out of the way, let's look at some of these stocks so you can piece all of this stuff together and start to grow your knowledge base. And remember, the numbers that I'm going to be talking about change over time, so be sure to look at the most current info and reevaluate if you need to. First up is going to be McDonald's. They currently have a yield of 2.12% and their stock price has increased almost 21% in the last year. Consumer discretionary has been on the rise and the last 3 years has been pretty big growth for the company in general. With the emergence of food delivery and more people using services to get their food, I think they will continue to do well, but that's just my opinion. Plus, if you're invested in McDonald's and your friends want to go there at 3 a.m. and order $20 worth of food each because they had too much to drink, you can support their bad decisions while profiting from it. It's a win-win. Well, for you at least. Next up is going to be Ellington Residential Mortgage. This is an REIT, which stands for Real Estate Investment Trust. If you don't know anything about these, be sure to join our Facebook group and look in the events tab for upcoming classes on the subject. Don't worry though, I'll be uploading them here if you miss them in person. The reason for holding this at the moment is that 4 hedge funds are also holding it, so they aren't going to be shorting it right now. The yield was just raised and it's now at 10.32%, and the stock over the last year has seen a modest 4.4% gain. Even if the stock declines 20% over the next 5 years and the dividend stays the same, you'll still come out with around a 32% gain just from that payout. I will say that sometimes companies will increase their dividend to attract new investors. And then when they have all the investors they want, they slash the dividend back down to where it was. So if you're going to go after companies with high dividends like this, you want to keep a closer eye on them to make sure they don't change it up on you and do any funny business and mess with your finances. Lastly is going to be Procter & Gamble. They are in the consumer staples sector and own companies like Bounty, Charmin, and Gillette, just to name a few. If there's another run on toilet paper and you own this dividend stock, maybe you won't be as pissed off while walking down the toilet paper aisle in the grocery store, knowing that all of those suckers are just buying products that you have stock in. Procter & Gamble has a dividend yield of about 2.5% and their stock has risen about 11% in the past year. It's also important to note that during the pandemic, they only saw a drop in stock price from around $125 a share to $100 a share. And it's shown to be a little bit more resilient to recession than some other companies out there. These are just 3 companies you might want to look at. Don't just pick them because I have them. Do some research and make a decision for yourself. I hope I gave you some inspiration and knowledge to move forward with dividend investing. If you liked the video, please leave a like and comment down below if you have any questions or you want me to cover anything else in another video. Check out the links to our website to sign up to beta test our new social investing app or sign up for our newsletter. First 2 weeks are free, so check it out. There's really nothing to lose. You can also join our Facebook group and find like-minded people to talk about investing with. There's about 25K on there and we ban everyone who spams. Thanks for watching, everyone. I'll see you next time.